Let's record. Good. Okay, good day, ladies and gentlemen. My name's William Parrott, and I'm a financial management tutor and have about 20 odd years experience of teaching financial management, primarily for the ACCA qualification. And so at the moment, F9 and P4. Today's little session is going to be on free cash flow valuations, and I'm joined by two ACCA students, Michael and Krish, who have contacted me saying they've got problems with free cash flow valuations and have agreed to sort of let me record this session and share it with others. I think you can see I've spoken to Michael and Krish before over the system, and so they've so they're waving. Look at that, very interactive. And I've used the system before with these two, and so they know the score. They've muted their microphones because otherwise we end up sort of talking over each other. As I'm going through things, if they have a question, they can stick it in the chat box, and indeed I will ask them questions, because otherwise, like typical lazy students, they'll start nodding off and that sort of thing. And this way I can keep them awake and make sure they're still paying attention. At the end, we'll probably have a little chat and make sure everyone's happy, and then crack on. Good. I think that's enough from me as a little introduction. We'll kill the photos because otherwise I start dancing around getting excited, and the camera loses me, and you don't need to sort of watch their reaction to the rubbish I'm coming up with, but hopefully it'll make some sort of sense. So let's kill the photos. There we go. Hopefully you can still see me, and hopefully you can see the screen. Good. As I said, what are we going to be looking at? It's free cash flow values. And this is a major valuation area. Yeah, I'm quite sure if I asked you what's the most important method of project appraisal, you'd tell me net present value. And effectively, that's what we're doing here. We're just treating a company as a big project, and we're saying the value of the project, the value of the company is what? The present value of the cash flows from the company. For some reason, it's somewhat under-examined in F9, if at all, although it is in the syllabus. But in P4, it becomes perhaps the most important method of valuation. There's a couple of ways about it, and let's first of all deal with what I'll call method one. And this is probably the most common method, both in reality and in your exam. And what do we say? And we say the total company value equals what? Well, it equals the present value of the future free cash flows discounted at the WACC. And that's the first thing we need to recognize. What else should we recognize? What value does this give us? And it gives us the total company value. And very often, what are we wanting to know and understand? It's the equity value, because it's the equity people have to buy in order to seize control of the company. And so what else should we say here? Our total equity value equals what? Well, it equals the total company value. What will this method calculates for us? Minus what? The value of the debt in the company. What else should we think about? And what do I mean by future free cash flows? And let's have a little heading here. Our future free cash flows. And what's the abbreviation we use for that? Well, it's FCF, and that's the abbreviation I will start using here. First of all, let's have a think. What do we mean by free? And free, if you like, is a bit of a silly word. Cash is never free. If you find somewhere where it is free, give me a bell. And basically, it's a slang word. And sometimes your friend says to you, what are you doing on Friday night? And you simply say, I'm free. And basically, what are you saying? You're saying, I'm available, isn't it? And this is available to the investors. And here, who are the investors we're looking at? It's both the equity investors and the debt investors. And this is the cash the equity investors and the debt investors could take out of the company without harming the company's ability to operate. What's a little exam definition that I would use here? And this is something you need to lock away in your memory. And it's simply this: our free cash flows equals what? The profit before interest and tax multiplied up by 1 minus tax. Sorry. And then one of you tell me, within the calculation of profit before interest and tax, what is the big non-cash charge? And what is the big non-cash charge in our calculation of profit? And Chris, Michael, someone type it into the chat box. Who can tell me? What's your big non-cash charge when you're calculating your profit? Are either of them awake? Are we going to get something in the chat box?
It's isn't it depreciation?
Yes, it is. Yeah, well done. And it's depreciation. And depreciation here is, yes, the big non-cash charge, and we're trying to get the free cash flows. And so what do? We add back the depreciation because it's a non-cash item. What do we then take away? And I'll explain these terms in a moment. But we then take away RAI, we take away IAI, and we take away IWCI. And what do all of these things mean? And what's the RAI? And that's your replacement asset investment. What do we mean by replacement asset investment? It's simply the cash the company needs to spend in order to maintain the company's current operating capability. In other words, yes, replacing old machines, etc., etc. And it's just to maintain the company's current operating capability. What's the IAI? Well, that's what? It's incremental asset investment. And what is that? Well, that's the investment the company needs to make in order to grow the business. In other words, the incremental, the extra bits, yes. And then what's the IWCI? Well, as ever, what's WC? It's working capital, isn't it? And that's our incremental working capital investment. And as you grow your business, as well as non-current assets, what else do you need to grow? Well, you need to grow the current assets, don't you? And so that's our incremental working capital investment. And that's our exam definition for, yes, free cash flows. As ever in P4 and the higher level papers, you need to learn to be able to use that fairly flexibly. And he'll give you the information in different ways. That's our first method. And let's just have a think about it before we start doing it. Yes, what are these free cash flows? And as I said, it's the cash available to the investors, and it's available to all of the investors, both the equity and the debt investors, because our starting point here is the profit before interest and tax. So it's without charging the interest. And so we've got the cash available to everybody. And because we've got the cash available to everybody, what do we discount at? And we discount at the WACC. And that's the average discount rate that's relevant to everybody, isn't it? And sure enough, if you've got the cash available to everybody and you discount at, yes, the discount rate relevant to everybody, what do you end up with? And you end up with the value for everybody. In other words, the total company value. And here Michael's saying what? What's the difference between free cash flows to the firm and free cash flows to equity? And free cash flows to equity are the free cash flows just available to the equity holders. And we'll come on to that later on. What I've described here as the FCF, the examiner very often does call this the free cash flows to the firm. And let's just write that in. And here we could say, this is often called the what? The free cash flows to the firm. And when the examiner writes that, he's meaning what I would just call the free cash flows. In other words, the free cash flows available to everybody. Good. Thanks, Michael. Excellent. Okay, let's now use that methodology. And here, what have I got? So I've got another page, hopefully, where I've come up with a little example. What can you do? Yes, pause your system and have a good read of that example. I actually sent it to Michael and Chris earlier, so I know they've already had a good read of it. As I said, if you want to pause it, have a read of it, you perhaps can even screenshot it and print it off. Let me now talk a little bit about this example. And here, I've very much stolen this from an old exam question from, I think, June 2011. And although I've laid out the information more clearly, fundamentally, this is exactly the same as a question in an exam. And it was part of a question 1 question. I've laid out the information more clearly here because I don't want to waste our time digging out the information. What does it say here? We've got all the information, and it then says, calculate the total equity value using both the free cash flow methods. And I've only talked to you about method 1 at the moment, and so that's the one we're going to do. Let's start having a think about that. And so let's go back to my notes. And so let's say method 1. And we're going to discount the free cash flows at, yes, the WACC, and that will give us the total company value. Well, within the question, we're given the WACC, and so that's not a problem. And what we need to calculate is the free cash flows. And I'm afraid I still write this down when I'm doing a question. It makes you think, it makes you focus. What's the little definition we've just talked about? It's this one here, isn't it? And that's what you want to lock away in your mind. Let's start working through it. And here, within the question, what have we got that we can use to calculate the profit before interest and tax? Well, let's go back to the question. And first of all, it says the most recent sales. And what else have we got? The most recent operating profit. It then says what? The forecast annual sales growth for the next 4 years is 6%. I'm afraid very often your examiner will leave you a little bit in doubt, and we have to make assumptions. And very often a later part of the question will ask you for your assumptions. And here, he's not told us how the operating profit, the profit before interest and tax, is going to grow. But the assumption is that if the sales are growing at 6%, what will happen to the operating profit? It will also grow at 6%. In other words, your operating margin is staying at the same level. If he wants you to change the operating margin, he's got to tell you, hasn't he? But effectively, that's an assumption we're making. What else would I say on this one? Yes. Later on in the question, what does it say? Yes, down here. The company will require additional investment in assets of 22 cents per $1 increase in sales. And so quite obviously, the increase in assets needed is based on the increase in sales. So we ought to calculate what the sales are going to be over the years. And so what becomes a suitable little layout here? We know the growth for the first 4 years. And so let's have columns for the first 4 years. And then after year 4, what does it say? Let's go back to the question. And it says, the forecast annual growth rate in free cash flows from year 5 to the foreseeable future will be 3%. And whenever you see the term for the foreseeable future, what's the examiner telling you there? It's a perpetuity, isn't it? And here it's a perpetuity with growth, And we then need to deal with that. But let's deal with the first 4 years first. As I said, first of all, what should we do? Let's grow the sales. And the sales growth rate is 6%, isn't it? And what's the figure we've been given? 16,146. And please don't waste time doing beautiful workings. And here, what does it say? Do you use that to calculate the terminal value? And yes, we do. Effectively, when we're looking from year 5, we're calculating the terminal value. And I would just say it's a delayed perpetuity with growth. But it's the terminal value, the value as at, yes, year 5 onwards, if you like. What is our estimate of the sales in year 1? And someone please check me. We all make mistakes. 17,115. Good. And as I said, please don't waste your time doing beautiful workings. And something like that is quite good enough. Yes, you're showing your marker what you're doing. As ever, don't let your numbers grow. Don't start using decimal points. The figures were given to us in thousands of dollars. And let's carry on working in thousands of dollars. By year 3, what do we think the sales are? 19,230. And there's no need to say how you calculated that. Well done, Krish. He's getting ahead of me. And by year 4, what have we got? 20,384. Good. What can we now do? Well, we can now calculate the profit before interest and tax. And we could have just done this, but we know we're going to need the sales figures for, yes, the additional investment in assets. And what was the figure we're given for the current profit before interest and tax? Well, it's that 5169, isn't it? And so let's use that. And as we said, assuming the operating margin staying the same, if the sales are growing at 6%, well, this will grow at 6%, won't it? And so what do we get here? 5479. Carry on that growth. I think 5808. Well done, Chris, you're on the ball. And I would have rounded up here, but you will certainly not be penalised for that. 6156. And then how much? 65. Oops, sorry, 6526. Good. Okay. What have we done? We've done the PBIT. What's the next thing to do? It's multiply it by 1 minus tax. Very often in examiners sort of presented answers, you'll see the tax line calculated and tax taken off to give you the figure after tax. And I'm afraid in P4, timing is always an issue. And here, what are we told is the tax rate? And let's just go back to the question, where have I given the tax rate? It's there, isn't it? It's 30%. And I'm afraid I would have no problems with, and I'm sure your marker won't, with something like this. And you can say times 0.7, and that's the post-tax figure, isn't it? And that's your post-tax figure. And so if we turn the 5479 into a post-tax figure, I think 3835. The 5808 will become what? 4066. The 6156 will become how much? 4309. And the 6526 is 4568. And here we've saved a bit of time, haven't we? We've saved a bit of time. Good. Once again, let's have a think what we're doing. And we've dealt with the 1 minus tax, haven't we? We've dealt with the 1 minus tax. What's the next thing to think about? It's the depreciation, isn't it? It's the depreciation. And here, within the example, there's a very important set of words that the examiner has often used. And he writes it slightly differently, but where is it? Yes, it's this set here. And what does it say? It can be assumed that the tax allowable depreciation is equivalent to the amount of investment needed to maintain current operational levels. Well, what is the amount of investment needed to maintain current operational levels? So that's what I call the replacement asset investment, isn't it? The RAI. And here you're being told the depreciation is equal to the RAI. And if we go back to the formula, remember, what does it say? It's plus depreciation and minus RAI. And if you're adding one and taking one away and you know they're the same, what's the net effect? Nothing at all, isn't it? And so here, what can we say? You know, these are equal, and therefore we can simply ignore them. And that's come up in many questions, and it's a great time-saving measure. And for people who don't notice it, they end up wasting time. And in some questions, he's a little bit nasty because he gives you the ability to calculate the depreciation. Well, you're simply not interested because whatever it is, you add it and you take it away, and the net effect is nothing. Good. That was nice and easy. We've dealt with those two. What's the final bit? And Michael's saying here, why don't you deduct the interest against PBIT? And remember, Michael, what are we trying to do here? And we're trying to calculate the free cash flows available to everybody. And if we take away the interest, if you like, we're already accounting for the return to the debt lenders. And here we want the cash available to everybody. And that's why we don't take away the interest. Is that okay, Michael? Excellent. Good, good. And later on in method 2, we will see that we do take away that because there we're looking for the free cash flows just for the equity shareholders. What have we finally got to think about? And it's the IAI and the IWCI. And as I said, you must be prepared to use these formulae, if you like, flexibly. And let's go back to the question. And what does he say here? And where is it? Yes, it's this little sentence here, isn't it? And the company will require additional investment in assets at 22 cents per $1 increase in sales. And so here, that's our additional investment in assets. The question isn't clear whether it's non-current assets or whether it's working capital. But I'm afraid we don't really care, because with both of them, what do? You take them away, don't you? And if you like, you just give us an ability to calculate both of those together. And so if I was doing this, what would I show? And I would have a line for IAI, IWCI together. And what did it say it was? Sorry, let's go back here again. 22 cents per $1 increase. Well, 22 cents per dollar is what? It's 22%, isn't it? And so I think we can do a little sum that looks like this. That's the sales in year one. What's the sales we know about at the moment? The most recent sales at 16,146. That's our growth in sales. And for every extra dollar of sales, we need 22 cents or 22% as the growth in assets. And what does that figure become? And I think that becomes how much? And I think 213. And that's a negative. We're taking it away. Good. What could we do? And for year two, we could calculate it in exactly the same way. 18,142 minus 17,115 times the 22%. The year two sales minus the year one sales multiplied up by the 22%. But Michael or Chris, you tell me, what is that figure going to grow by? What percentage will that figure grow by? And what percentage do you think that will grow by? See if you can type something in. Yes, well done. And I like 6%. Yes, I would agree with that, Chris. Well done, Michael. Good, good. Because fundamentally, what's happening? Your sales, which are driving this, are growing at 6%. And if the sales are growing at 6%, what will this figure grow at? It's 6%. And I can promise you that's right. If you don't trust me, you can do it by steam and do the 18,142 minus the 17,115 times the 22%. And you will get, what am I going to get here? 226. And once again, we can just carry on. Year three, what's it going to be? And I think 239. And year four, what will it be? 254. Good. What have we done? Go back to the formula, and I think we've dealt with IAI and IWCI. And if you like, we've just given us a methodology that hopefully deals with both of those, and we've done it. And what can we now do? It's add it up. Be a little bit careful, because remember, actually, we've only got two things to add up, haven't we? And just be careful. People have a nasty habit of adding up the whole column when you're in a hurry, and that's just silly, isn't it? And we want the post-tax profit before interest and tax minus our IAI, IWCI. And what were the figures I got? 3622, 3840, 4069, and 4314. And that's our free cash flows. And what do we need to discount that at? Well, it's the WACC, isn't it? And here, what is the WACC? Well, what did I say? And the WACC is 13%, isn't it? And let's use that. So look up the 13% discount factors. I'm not going to make you do that, because if you can't discount, you really shouldn't be doing P4, should you? What would I say here? Yes, and we must recognize our year one cash flows are what? Well, the cash flows that arise during year one, normal assumption, when do they come? It's the end of year one, isn't it? And so straight away here, we're using the 1 year discount factor. And please be careful, because people have a nasty habit of writing 1 here, because you're used to doing NPV calculations, where your first column is what is T0, isn't it? In other words, now, and therefore you want a 1. And what's that? 0.783. That one's 0.693. And then finally, what's the 4 year discount factor? 0.613. Multiply through to get the present values. And I haven't done this before. So one of you please check me and shout if you think I'm being silly. I think that's 3205. The 3840 becomes how much? 3007. The 4069 becomes how much? 2820. And the 4314 becomes how much? 2644. What would I then do? Add those four together. And what's the value of the free cash flows for the first 4 years? And I think that comes to how much? 11, 6, 7, 6. Oh, sorry, 6, 7, 6. Why did I write a 4? Thank you, Michael. Good. What do we now need to think about? Well, it's year 5 into perpetuity. And this is a delayed perpetuity with growth. And remember, what did I say in the question? What's going to happen to the growth of the free cash flows after year 4? And I think I said what? Yes. The forecast annual growth rate in free cash flows from year 5 for the foreseeable future is the 3%. And so that's what we need to use. It's been a very common requirement over the years to deal with a delayed perpetuity with growth. And what's the first thing we want? Well, that's the free cash flow in year 4, isn't it? Multiply it by 1.03. And what's that? It's the free cash flow in year 5. And what must we then multiply by? Well, we must multiply by the perpetuity with growth factor, isn't it? And so here, the perpetuity with growth factor. And this is something you must lock away in your mind. What is it? It's 1 over R minus G. And remember, what's our discount rate? What's our WACC? It's the 13%, isn't it? And what's our growth rate? It's the 3%. And then what must we multiply by? I'm sorry. We need to multiply by a suitable discount factor, because our perpetuity is delayed. And one of you try and tell me, which discount factor should we be using here? Which year discount factor should we be using? And I like, yes, the 4-year discount factor, and that looks good, Michael. And I'm afraid people have a nasty habit of getting this wrong, because they see year 5 here and they want to use the year 5 discount factor. And you have to say to yourself, this perpetuity with growth factor, a normal perpetuity factor, and indeed the annuity factors, they all assume your first cash flow is at year 1. And here, the first cash flow for our perpetuity is year 5, isn't it? What's the difference between year 1 and year 5? It's 4 years, isn't it? And our perpetuity is 4 years late. And so here, you're quite right, we want the 4-year discount factor. If you forget all of that, what's the thing to remember? You're going to be using this figure here, the last figure you've used, yes, in your previous calculations. And so we want 0.613. Multiply that through, and what do we get? What's the present value from year 5 off into perpetuity? And I think all of that becomes how much? And I think that's 27,238. Good. What can we now do? It's add the 11676, the value from the first 4 years, with the value of the perpetuity from year 5 off into the future, and we've got the total value. And what is that? Oh, sorry, hit the wrong button. And I hope someone's still checking me. What does that become? 38,914. And remember, we're working in thousands of dollars. And someone tell me, what is that 38,914? What's that the value of? What is that the value of? Oh, let's stay with that. What is that the value of? And what is that 38,914? Excellent. It's the value of the company, and it's the value of the whole company, isn't it? And that's our total company value. In other words, the value of the debt and the equity. What can we then say? And we can then say what? Sorry, I'm losing the figures for you, aren't I? Where are they? There we go. That's the 38,914, the value of the total company. As we said, very often we want to know the total equity value. And what did I say? The value of the total company minus the value of the debt. And what have I said in the question? What's the value of the debt? Well, what is it? And it says here, the company has debt with a book value of 5.5 million, on which it pays interest at 9% per annum. And due to the current low interest rates in the economy, the debt has a market value of twice its book value. And so in other words, what will be the market value of this debt? Well, it's the 5.5 times 2, it's 11 million, isn't it? And let's take that off. And so minus 11 million, the 5.5 times the 2. What does that come to? 27,914. In other words, what have we got? It's about $27.9 million, isn't it? $27.9 million. Good. That's method one. We're running a bit short of time. The computer's already warned us. Let's zing into method two. And what should we say here? And what is method two? Well, here, what do? And we calculate the value of the equity in total directly. And we say the total equity value equals what? Well, it's the present value of the future free cash flows to equity. And once again, there's good matching here. If you're using future free cash flows to equity, what do we discount at? It's discounted at the cost of equity. And here we're looking at the free cash flows available to the equity holders, and we're discounting at the return the equity holders want. And what does it give us? It gives us the value to the equity holders, doesn't it? And hopefully you can see there's good matching here. What's the abbreviation we use for this? It's FCFE, and that's your future free cash flows to equity. What's the little formula? And the FCFE equals what? Well, luckily there's not too much to do. It's the free cash flows, and then what? It's minus the post-tax interest paid, and then plus or minus finance raised, or indeed repaid. And in this question, and in most questions, there's no finance paid repaid or raised. All we need to think about is the post-tax interest paid. You must think in terms of post-tax, because remember, your free cash flows, when we were calculating these, we multiplied by 1 minus tax, and you're multiplying you're dealing with a post-tax figure, aren't you? You're dealing with a post-tax figure. Let's quickly do it, and hopefully we can do it quite quickly, because what can we do? We can start with the free cash flows, year 1, 2, 3 and 4. And I think we had what? 3622, 3840, 4069, and 4314. What do we need to take away? It's the post-tax interest. And here, remember, if we go back to the question, what does it say? We've got 5.5 million of debt, and what's the interest rate we're paying? It's 9%, isn't it? And remember, what's the tax rate? It's 30%. And so after the tax relief, effectively, what does the company pay of that? It's 70%, isn't it? And so what's the little calculation we need here? Well, there's the debt in terms of thousands. There's the 9% interest. And then multiply by 1 minus tax to turn it into a post-tax figure. And what does that become? And I think 347. And that's going to be the same every year. Good. What do we get, therefore, as our free cash flows to equity? Well, what did I get? And I got 3275, 3493, 3722, and 3967. Good. So those are our free cash flows to equity, and so we discount those at the cost of equity. And what is the cost of equity in this question? What are we told is the cost of equity in this question? Someone tell me, make sure you're still awake. Exactly, it's 14%, isn't it? And I'm afraid, I'm conscious we might be running out of time. If you apply the 14% discount factors and multiply through to get the present values, I think when I added all of that together, I got what? And I got, I think, 10,418. And if you don't trust me, have a go at it yourself. Have a go at it yourself. What have we then got to think about? It's year 5 off into perpetuity. And we can go about it in exactly the same way. And there's the year 4 free cash flow. There's the growth, and effectively that's the year 5 free cash flow, isn't it? To equity. We then multiply by 1 over R minus G, but this time our discount rate is the 14%. It's still the same growth rate. And once again, what must we do? Let's use the 4-year discount factor, and that's the 0.592. And when I multiplied all of that together, what did I get? And I think that came to 21,990. Add it all together, and what have we got? And I think 32,408. And what's that telling us? And that is the value of the equity. And so our total equity value is how much? Well, it's about $32.4 million. Good. What did we get as the value of the equity when we did the free cash flow method instead of the free cash flows to equity? Well, if we look back here, what did I get in my sums? And I think I got 27.9 million, didn't I? I'm afraid in any valuation question, you must expect potentially big differences. And here, yes, there is a difference. And why is that? Well, markets aren't perfect and the information is not perfect. And indeed, the information here is just information the examiner made up and I made up. And hence it's by no means perfect. And so although these two figures should be, yes, technically exactly the same, they're very unlikely to be. And sure enough, we've got a bit of a difference. But they're in the same sort of ballpark, aren't they? The value of the equity here is about 30 million, isn't it? And I'm afraid that's the best we can expect. And don't expect things to come out scientifically correct. Good. Hopefully that little example, yes, has given you some idea, yes, of the difference between a free cash flow valuation and a free cash flow to equity valuation. It's just good matching. If you have the free cash flows, the cash flow is available to everybody. If you discount the WACC, the discount rate available to everybody, and you get the total value, the value to everybody. And if you want the value of the equity, you have to take away the value of the debt. If you take the free cash flows to equity, you then discount at the cost of equity, the rate the equity investors want, and that then directly gives you the value of the equity. Good.